guys, today we'll be talking about partnership. But first, let's have a review of the different forms of business organizations. When classified according to ownership, we have sole proprietorship, partnership, and corporation. So a sole proprietorship is the basic form, which is owned by only one person. A partnership is owned by 2 or more individuals, while a corporation requires 5 to 15 incorporators, but may have many shareholders. When classified according to activity, we can have the service entity, which is engaged in the provision of services, and the merchandising or trading entity, which purchases goods and resells these. And then we also have a manufacturing entity, which is engaged in the production of goods and the conversion of raw materials into finished goods for sale. In this video, we will be focusing on partnerships. However, before we can fully understand partnerships, we must first be able to define the term and identify its features. Partnerships, as formally defined by Article 1767 of the Civil Code of the Philippines, is a contract whereby 2 or more persons bind themselves to contribute money, property, or industry into a common fund with the intention of dividing the profit among themselves. To make it simpler to remember, just think that a contribution and the intention to divide profits is necessary. The contribution may be in the form of money, property, or industry, which is also basically a person's skills or services. Remember that no partner may be excluded from the sharing in the partnership's profits. Any stipulation of such would be considered void or illegal. So, partnership has certain features distinct or special to it. These are mutual agency, limited life, unlimited liability, co-ownership of property, co-ownership of profits, legal entity, and taxable entity. Mutual agency means that any partner is considered an agent of the partnership. Each of them has the right to enter into contracts binding the partnership so long as he acts within the normal scope of business operations. For limited life, this just means that it is easily dissolved by partners either voluntarily or involuntarily. Voluntary dissolution can be caused by withdrawal, retirement, bankruptcy, or admission of a new partner. Involuntary dissolution occurs through bankruptcy, death, or incapacity of a partner. So, with the exception of limited partners, claims of creditors may be satisfied using the personal assets of general partners as stated by the unlimited liability. This means that the liability of general partner extends beyond his contribution to the partnership. But take note that this does not apply to limited partners. However, a limited partnership would still have this characteristic since a general partner is a requirement when forming a limited partnership. Co-ownership of property just means that properties contributed to the partnership is owned by the partnership. They are no longer the personal properties of a partner. Next, we have co-ownership of profits, which means that each partner has a right to share in the firm's profits as a return on their investment. Legal entity states that a partner has a legal personality separate and distinct from that of its partners. It may therefore acquire properties in its own name and enter into contracts. As a taxable entity, partnerships are taxed like corporations except for general professional partnerships. GPPs are organized for the exercise of profession, such as CPAs, doctors, and lawyers. Now we move on to the different kinds of partnership. This list is not exhaustive, but these are the basic types, which you may need to know. When classified according to activity, partnerships can either be trading or non-trading. Trading partnership is a partnership whose main activity is into the manufacture or purchase and sale of goods. Non-trading partnership would be engaged in the provision of services. When classified according to liability, a partnership can either be general or limited. General partnerships are partnerships where all partners are general partners, meaning their liabilities extend beyond their capital contributions and creditors may go after their personal assets. Limited partnerships, on the other hand, are composed of limited partners and at least one general partner. Limited partners are those whose liabilities are limited to the extent of their contributions to the partnership. This means that creditors cannot go after their personal assets to satisfy their claims. Partnerships may also be classified according to object. Under this, we have universal partnerships and particular partnerships. Universal partnerships can either be universal partnerships of all present property or universal partnerships of profits. A universal partnership of all present property is defined by Article 1778 of the Civil Code as one in which the partners contribute all the property which actually belonged to them at the time of the constitution of the partnership to a common fund with the intention of dividing the same among themselves as well as the profits which they may acquire therewith. All assets contributed to the partnership and subsequent acquisitions become common partnership assets. Simply put, this just means that all properties contributed by the partners to the common fund at the time of constitution, all the property subsequently acquired, and all the profits derived from the property belong to the partnership and are to be divided among the partners. According to Article 1780 of the Civil Code, a universal partnership of profits comprises all that the partners may acquire by their industry or work during the existence of the partnership, and the usufruct of movable or immovable property with which each of the partners may possess at the time of the institution of the contract. The original movable or immovable property contributed do not become common partnership assets. This just means that only the profits derived from the properties contributed are divided among the partners. The partnership only acquires the right to usufruct or the right to use the properties belonging to another and the right over the income derived from such. This means that the properties contributed still remain the partner's own and do not belong to the partnership. Article 1783 defines a particular partnership as one which has for its object determinate things, their use or fruits, or a specific undertaking, or the exercise of a professional vocation. Next, we have the different kinds of partners. When classified according to investment, we have a capitalist, industrial, or a capitalist-industrial partner. Capitalist partners are those who contribute capital, whether in the form of money or property. Industrial partners contribute industry, labor, skill, or service. A capitalist industrial partner is one who contributes money, property, and industry. When classified according to liability, partners are either general or limited. A general partner is one whose liability to third persons extends to his private property. A limited partner is one whose liability to third persons is limited only to the extent of his capital contribution to the partnership. When classified according to participation, partners can either be nominal or secret, silent, or a managing partner. A nominal partner is a partner in name only. A secret partner is one who takes active part in the business but whose connection with the partnership is concealed or unknown to the public. A silent partner is one who does not participate actively in the management of partnership affairs. Lastly, a managing partner is one who manages the business actively. So here are the pros and cons of a partnership. The advantages of forming a partnership include the ease of form and dissolution. It can be formed orally or in writing as long as the two requisites discussed earlier, namely the contribution and the intention to divide profits, are present. Next, a partnership also has a greater amount of capital compared to a sole proprietorship. There is also relative freedom and flexibility in decision-making compared to a corporation. This is because decisions can be made by mere agreement of partners, and they don't have to go through the formalities required with a corporation. Better management resulting from the combined experience and skills of persons is also another advantage. More than one person supervises the business, allowing them to manage the business better. A partnership also has the characteristic of unlimited liability, and this makes the partnership more reliable from the creditor's point of view. Disadvantages of forming a partnership include the lack of business continuity since it is easily dissolved. There is also difficulty in transferring ownership interests due to delectus personae. Delectus personae means that each partner has the right to choose the individuals with whom he will associate with. In other words, when transferring ownership interest in a partnership, the consent of all partners is required. If one person refuses the admission of an individual, he or she cannot become a partner. A partnership also has a limited amount of capital compared to corporations. And again, while unlimited liability is an advantage, it is also a disadvantage since it deters or discourages many from joining partnerships.